Ladies and gentlemen, thank you for standing by and welcome to the Healthscope Analyst and Investor presentation for financial year 14 results. At this time, all participants are in a listen-only mode. There will be a presentation followed by a question and answer session, at which time, if you wish to queue for a question, you'll need to press 0 followed by 1 on your telephone. Please note this conference is being recorded today, the 27th of August 2014. And I'd like to hand your conference over to your host for today, Robert Cook, Managing Director, and Michael Samuels, Chief Financial Officer. Thank you, Robert. Please go ahead.
Yeah, thanks for everyone for joining the call. As you would no doubt, most of you would be aware, Healthscope listed on the Australian Stock Exchange on the 31st of July. And as you would hope and expect, nothing has changed in the last month or so that detracts from our confidence in our FY15 forecast and in the future of the business, and we'll talk about that as we go through the presentation. Also, based on the market understanding of the business through the IPO process, I intend to keep commentary fairly brief and allow plenty of time at the end for questions. So I'll try and talk through the slides and the number for those of you who have the presentation in front of you. Slide 3 is just a timely reminder that 79% of our EBITDA comes from the Australian Hospitals Division, 7% from Australian Pathology and Medical Centres, and 14% from the quiet achiever of the business, which is International Pathology, and I'll take you through where those businesses are at and how they've performed over the last 12 months. In terms of financial highlights on slide 5, obviously the FY14 operating results of Healthscope Group are in line with the FY14 statutory forecast in the prospectus. Obviously, I'm not going to give a trading update every month, but obviously, the June numbers are in the account and met and slightly exceeded expectations at an EBITDA level. And everything in the trading through July and even early parts of August continues to reinforce the guidance that we've given in the prospectus. I now turn to operational highlights on page 6. And again, in the interest of time, the only thing that's really changed from the prospectus and our roadshow presentation is that we continue to gain approval for development of approvals from local councils, in particular Norwest in New South Wales, which is one of our bigger hospitals and bigger projects, and also Knox in Victoria have both been received from local council, and we've already started early works at both of those sites in anticipation of receiving those permits. We've also completed the acquisition of Frankston Private in Victoria and divested Brisbane Waters, which is in Gosford in New South Wales, to Healthscope over the last month or so. I'll now hand to Michael in slide 8, which is to go through the numbers for FY14 on the group and divisional performance.
Yeah, thanks, Robert. So I'm on slide 8, and pleased to be able to report that the FY14 group delivered revenue of just over $2.3 billion, 5.1% up on last year, an EBITDA of $357.3 million, a pleasing 9% growth, and at operating EBIT level $262.3 million, 11.2% up on last year, and at a group EBITDA level 60 basis points in margin improvement to 15.4%. I just make the point that everything below operating EBIT is impacted in some way via the IPO process, so just in analysing numbers, just be careful on that, but I'll touch upon that through the course of this presentation. Turning now to slide 9, we had $31 million in other expenses, non-operating expenses, and they're summarised in the table there. I don't propose to go through all the detail, and again, as with other elements of this presentation, very much consistent with the prospectus. Slide 10 just summarises the FY14 operating reported results compared to the prospectus, and as you can see there, pleasingly, revenue within 0.5%, EBITDA pretty much spot on, and we're a couple of $1 million in front of at the EBIT level, and operating margins very much in line. So the reported result is very much in line with the prospectus. If you tried to line up our aggregate accounts lodged at the ASX this morning with the prospectus forecast below operating EBIT, you get into some changes in corporate structure. The corporate structure that we're reporting here is a slightly different structure to that we are today post the IPO, as well as a range of transaction costs, many of which make their way into the FY14 results. So I'll just caution against that, and there is an appendix to this presentation pack that tries to do that reconciliation for you, and it's also contained in the ASX release itself. So I don't propose to go through that other than just to reinforce the fact that the FY14 result is entirely consistent with the prospectus forecast. Slide 11 just summarises our balance sheet and cash flow, and the only 2 points to make here is that our patterning of a very strong cash flow performance of converting EBITDA to cash continues at a rate of 102%, and all the numbers on that slide reflect the state of the business as at 30th of June, and our capital structure is entirely different post-IPO, with a net debt to EBITDA ratio of 2.5 on listing on July 31, 2014. So at the group level, a good result and consistent with prospectus forecasts. I'll just briefly now turn to slide 13 and go through the three segments one at a time. Hospitals is the engine room of the business, a strong performance in FY14, revenue of 1.753 billion, 5.5% up on FY13. EBITDA 7.7% up to 296.9 mil, and 30 basis points improvement in operating margin to 16.9%. I think the other points to make about this is that it's a good solid result. Our revenue growth is basically very much an organic growth number. There's very little brownfields impact in the FY14 period. And we also have a range of key sites that are limited by growth because of capacity constraints, which really goes to the heart of the brownfield strategy that we articulated through the prospectus of the IPO process. Our efficiency initiatives continue to deliver EBITDA margin, growing another 30 basis points. Importantly, our brownfield building activity program is on track. It's ramping up through FY15 for a range of key developments which will start to come online from FY16 and beyond. So that's really, I guess, summarises the hospital business. On slide 14, international PAT, which represents 14% of group EBITDA, had an excellent year. 17.6% revenue growth to 224.2 mil. 18.5% EBITDA growth to 52.8 mil, and a slight improvement in operating EBITDA margin. New Zealand delivered the majority of that strong growth. New Zealand grew 6% top line and EBITDA 33.9% in local currency basis. And basically the growth reflects strong contribution from the DHB contracts and an 8.5 month impact from the CML acquisition made during the course of the year. Singapore delivered another strong result with just good organic growth there, revenue of 6% and bottom line of 12%. And Malaysia had solid revenue growth of nearly 5%. EBITDA was impacted by a more conservative approach to provisioning for doubtful debts in the first half of the year, but the underlying performance in Malaysia continues to grow. So it's international pathology. Slide 15, Australian pathology, which in this segment is our Australian pathology business inclusive of medical centres. Pleasingly, a strong turnaround in EBITDA from a business that has been restructured over the past couple of years. Revenue of 348.9 mil. But I guess, importantly, that revenue number is impacted by a range of business changes that were put in place during the course of the year. If I back out the impact of those small divestments and some restructuring of our collection centre network in New South Wales, the underlying Australian pathology revenue growth was around about 4%. EBITDA up to 26.1 mil, 30% up on the 20 mil from FY13. And I think what that's telling us is that the revenue the restructuring work that we've completed in the likes of New South Wales, as well as our focus on pursuing profitable growth, not just revenue growth, is delivering performance. In this segment, we obviously still see rental pressures out there in the market, in the pathology collection centre area, and our medical centre business continues to track well with solid top and bottom line growth. So I think solid results at group level, solid results across all the segments, and I'm happy to hand back to Robert to go through a strategy update.
Thanks, Michael. So just sort of, this is really a reiteration and just an update of again, of the strategies that we've got in place. I think the occupancy in the hospitals, we're seeing good growth in high-end specialties, which we've targeted, particularly neurosurgery, cardiac, orthopaedics. We have been, as Michael said, we have been restricted at several of our larger sites by bed capacity on certain days, and that's certainly something that we look forward to addressing, particularly in the latter part of 16 and 17 as the additional capacity comes online. The overall dynamics of the hospital admission market have not changed. We're still seeing some growth occurring in private patients in public hospitals, but the overall demographics continue to support strong growth across the board. And we're particularly pleased that many of our sites are not only eastern seaboard, but they're high growth areas and next to or co-located with a public hospital. And many of those public hospitals are also experiencing significant capital growth, which bodes well for the future of recruitment of doctors to those areas. In pathology, I think Michael just talking about the come back to pathology, move on to brownfields. We're on track. Work's commenced, and until the big rain in Queensland and New South Wales, we're actually ahead of schedule, still ahead of schedule on the Gold Coast, National Capital and a couple of other major projects. So all in line with what was said and on track, which is good. The relocate and grow, the Gold Coast private is one that I referred to, which is ahead of schedule. Holmesglen, we've obtained the permit. We're still in negotiation with Holmesglen and several government departments, mainly around technical legal issues to get a pretty complex project signed off, but still on track to complete that one in the next couple of months and start construction early next year. The PPPs and government, obviously, Northern Beaches, we await in a high degree of anticipation the result on that, which we believe is scheduled for late September, early October. So we'll update the market as soon as we hear something, but we've certainly been active in answering a lot of questions and quietly confident about that one. Interestingly, in the last 2 months, there have been a number of RFPs put out by government, including the ones that I mentioned here, the Royal Children's Hospital site in Queensland, Palmerston, Northern Territory. So we will be pursuing several of those, but we will certainly be pursuing with a discipline to make sure that it does meet our criteria, particularly around transfer of risk, payment methodology, and in particular use of private sector EBAs is certainly a key feature that we look for before we get too excited and respond to what we think will be an ever-increasing amount of public opportunities that coming up in the next few years. International growth, we're still looking at that, and we've, as I indicated during the roadshows, we believe that we will be in a position to obtain some management contracts or some other variation there to a management model. We've now got a bit more time, not doing roadshows, to get refocused and re-energised on a few of those projects which we've had on the back burner for the last 12 months. So again, nothing really to update on that point. Slide 19 is relocate and grow. That's a real, the brownfields update on page 18. again, nothing has changed from the prospectus, so I think I've just covered that off. The next slide was slide 19. That's a real photo of the Gold Coast about a week ago, and it's a photo of what Holmes Glen will look like in about 18 months' time. The conclusions for the business, really, feeling very confident about our strategies and the way the businesses are performing. And I think, just to reiterate again, a really strong management team. Our top 200 executives come together in Adelaide in 2 weeks' time, and there's a lot of enthusiasm, a lot of energy, a lot of ownership of what in effect is 70 local business units, and the vast majority meeting or exceeding expectations, and we look forward to that sort of cascading into obviously the total company number. So from a hospital point of view, it's really getting on with the brownfields and getting on with a number of strategies around local volume focus and targeted specialty focus, continuing to work with the health funds. I think we continue to blaze a trail there, and we haven't been asleep, and hopefully we can announce some further work that we've done on quality initiatives, and particularly the transparency of those initiatives and our performance, which is saving health funds millions of dollars, and more importantly, leading to better clinical outcomes for our patients. International pathology, as I said, it's a quiet achiever. There's some small growth prospects and some tender opportunities over the next 12 months in New Zealand, and we're certainly assessing those and hoping that we have a good swing at those. Australian pathology, I don't think I'm going to change from anything that competitors have said. The overall marketplace is still got significant issues. Obviously, the number of collection centres has continued to increase. We increased the rollout much less than our competitors, but the overall number of collection centres in the market grew by approximately 500 over the last 12 months for a volume increase of 5 or 6%, depending on which numbers you want to use. So overall, that issue has not gone away. We still remain optimistic through our Pathology Association membership, and we're certainly aware of discussions with government and AMA, and they've been ongoing for several months, and we keep getting a bit more optimistic that a favourable decision might be reached, but there's no clarity yet in official terms about whether the government will address the rental issue and the way that that's currently structured within the marketplace. Again, there's the $7 co-payment for our medical centre business has had little or no impact. For pathology, I mean, we did see a slight softening in June and July, but certainly August has got back to a more traditional growth rate. So I don't want to comment on 1 or 2 months results. It could have been it was a pretty good weather, and August has certainly been a bit colder and a bit wetter. But obviously pathology would be challenged by that $7 co-payment in terms of how we collect it in several settings, given that 50% of episodes, we hardly even see the patient, so trying to collect that would be very difficult. So we watch the political landscape like everyone else. I saw the minister on TV last night still arguing that it was the right way to go and they were going to push it through, but we can't respond to what is still at this stage a proposal. Turning to the conclusion, based on the current trading performance and the current information, Healthscope Group is on track to deliver the FY14 financial forecast, which was included in the prospectus, and the FY15 operating EBITDA of $387.3 million, and the FY operating EBIT of $2.84.7 million, and we are confident that we will hit those numbers and are on track to do so. Thanks for the interest in the company, and hopefully in the February results we'll have a little bit more to talk about. That's new news, not old news, but we certainly appreciate the interest, and we'll maintain the dialogue as best we can in a public environment. So thank you.